Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. All right. Well, we had a great show on Wednesday, our first guest appearance that we had on Options Guide TV, and it was a good friend of mine, uh, Russell Rhodes. I'm sorry, I apologize for that. A little bit of a tongue twister. But Russell is basically the godfather of the VIX, if you will. I do know that there's nobody out there that has written as many books on the VIX index and gone into as much depth as Russell has. So I always love to bring Russell in on the show, highlighted some of the things that he likes to look at when we're thinking about the VIX, and gave a couple of good trading ideas that Russell likes to do week in and week out, or month in and month out, on different products that are centered around the VIX. So I highly suggest going back and watching that show. It's one of my favorites so far on Option Guide TV. And well, I think the marketplace was listening to us, because I look at where the VIX is at. Both Russell and I were kind of befuddled by the fact that the VIX was trading right down around that 13 level. We now see the VIX index trading closer to, well, 16 and a half, going into a big week as far as the markets are concerned. And that's mainly because we're going to have the budget talks have begun in Congress. A new budget needs to be determined. As of the 1st of October, there will be a plethora of different departments within the government that may have their budgets cut. And the rumor has it that it's going to be very heated discussions in Congress about cutting costs across the board on many different features. And because of this, it's not as nerve-wracking as the debt ceiling. That's really straightforward. Either you increase the debt ceiling and the government keeps running, or you don't allow the increase and the government stops. In this instance, it's going to affect certain departments of the government, and certain departments could be shut down because their budget basically gets removed or drastically cut. So because of that, the marketplace is kind of reacting. So the Fed came out and had a little conversation on Wednesday, the day that Russell and I were chatting on Options Guide TV, and they did as expected. They did not raise interest rates, but they did say that there is potential for an interest rate hike going into November, or they're not done yet raising interest rates. We don't know if exactly in November. We're looking at about a 40% chance in November at this point in time, based off of the CME futures and the Fed Watch tool. And so that's where we're at. And because of that, we finally got a reaction in the market. We had a down day, and the VIX reacted accordingly. And we had a big spike up in the VIX. But right now, today, it's down $1.36 because the markets have bounced back a little bit. We see the SPX up about 0.5%. We got the NASDAQ trading right up almost 1%, looking at the QQQs, which today we're going to focus on our QQQ trade that we put on because we had the down day. And so we want to see if there's something that we can do with that. And going into these talks next week, I want to put on one of my favorite SPX trades, something that I like to do on a weekly basis. And I might even go a little bit longer out in time. We're going to look at exactly what day everything's going to come through on the budget talks and October 1st. So we're going to go out beyond, because we have so many different expirations that we can choose from in the SPX. We're going to go a little bit beyond. We're going to go out to the October 2nd expiration, and we're going to go a little bit further out. So I'm going to adjust my butterfly trade that I usually like to do based off of being a little bearish on the marketplace, and make it try to fit this major news event, if that makes sense. So with that said, let's go to the TradeHawk software, and we'll pull up the QQQs. And we're going to start by looking at the put paper trade that we put on. We did the October 13th expiration, and the strike on that put was 368. Right now, we got the Qs trading at 361. So we're in a good spot on that trade, right? So we need to do something with it. And that something could easily just be that we want to just sell it and get out. But let's take a peek at it. I haven't even looked at where it's trading at yet, so I need to make sure I have the right expiration date. So 10/13 is the next expiration. Let's get out to there. Here, October. There's so many expirations in the SPX, or in the QQQs and the SPX too. That's also true. So here it is, 10/13. We got 21 days remaining. The strike that we bought was the 368. Here's the bid. Here is the ask. We paid for that option contract $5.54. We are now trading at $9.44. So we almost have a double on this trade. And that's, I would definitely, so here's the two things that we could do. If I put this trade on, we did say that we wanted to get bearish going into October. That's why we went out to October. September and October are usually months that do not perform as well on the calendar. No magic reason as to why, except for that it's September and October. And those are the only 2 months where you really usually see volatility spike, and you usually overall the market has underperformed other calendar months. Just by looking at the numbers. That's simple. That's straightforward. So we bought the 368 strike put. We could sell it now for 941. I would have had a limit order in on this paper trade, probably somewhere right around 10, because I paid $5.54 for it. I guess I would have probably put it at 11, usually right around a double. So when the market went down, I probably would already be out of the trade. That's simple, because the market obviously came down and now it's back up a little bit. It's up, and it's nothing to sneeze at where it's back up. It's up 1% today at $3.55. So might have got out of that trade. Okay, add a double. Now, Options Guy TV isn't all about just looking at a winning trade, right? That's simple to decide what to do on a winning trade. But we want to look at different ways to approach trading. And so we did mention that if the market did go down, what we may do is roll into a diagonal spread. And inside the options playbook, we talk about put by diagonals if you want to go there and learn a little bit more. One alternative is to just stay in this expiration and say, we're down, let's take our money off the table. How can we do that? Well, we have $5.54 that is our cost basis, and that's at risk because we did one contract. So that's $554 plus commission. So if you want to stay bearish, but you would like to take the money off the table, the simple thing to do without making it complex whatsoever is to roll into a long put spread with the same expiration date. So you're long a put, you sell a put against it. It still gives you some downside, but you can take a lot of your risk off, or it still gives you some upside if the market goes down, but you're taking a lot of your risk off the table. So if we look even all the way down at the 360 strike, that is trading right now on the bid $5.72 for more than we paid for the trade. We paid $5.54. So if we sold that option contract, we would be basically playing with the house's money. We would have no more risk in our portfolio, but we would still have some upside potential. So that's a possibility. Then the other thing is, if we wanted to bring in a little bit of income, right? Let's say we want to at least make a couple of $100 on it. Well, we're going to reduce our opportunity to the downside, and we could sell something that is maybe 5 points away from where our strike price is. So we could sell the 363, we could sell the 364, and you'll note that we're already in the money on these trades, right? But we're selling that option contract, creating this long put spread. And if the market just stays where it's at, well, at expiration, we can max out on that trade. So it's up to you if you wanted to do that on that expiration date. Now, what I would probably do if I was going to adjust this trade is I would go more shorter term and sell something a little bit more out of the money. Now, October 2nd, is that scary day, right? Because there's a lot of news that's going to happen between now and October 2nd, as far as we've been talking about the budget talks for quite some time. So I would like to look at the 29th, 7 days away, but we got to see what we can get for it. And that's actually not that bad, right? So 368 is our strike price. Now, here's the situation. This is, to me, it's a very advanced trade. And I think the hardest trade to pull off as a beginning trader is when you're dealing with options with different expirations. Now, on the trading floor, when we had a diagonal trade, the way that it worked, and 1 second here, let me go full screen, I'm sorry. And the way that it worked on the trading floor is you would be standing in a pit. So think back to the olden days where all the traders were down on the floor, and you would look up at the quote screen. I guess my quote screen is up there on my ceiling. And while you're looking up there, people would come in and say, I want to do this trade, which would be a diagonal. And I would have to look on the quote board diagonally to see the quotes. Why? Because of the way the expirations are listed on the board, much the same as the TradeHawk software is across the top of the trade grid, like this. So in order to give you a quote on that diagonal spread, I have to look diagonally on the quote board, and hence the term diagonal. Now, the first one that we looked at, that was just a long put spread, just a simple long put spread. That would be referred to on the trading floor as a vertical. Why? Because you're in the same expiration, and all you have to do is look up vertically and see the different strike prices to give a quote. So what we're trying to do is a diagonal, which means that you have different risks if the shorter term option contract gets in the money prior to the expiration date. So it's a trade that you have to manage a lot more. You do not want that option contract to get in the money if you're going to look to do this trade. So I'm usually going to err on a diagonal, going a little bit further out of the money and getting less premium. Okay. So we're at 361. A 1% move in the NASDAQ, it's telling us, is right around three points, right? So I'm a little nervous. A 2% move over a week is a fairly decent sized move. It could possibly happen. Obviously, like I said, all the news that is out there. The VIX is up a little bit, which is nice, which also means that the volatility index, probably in the QQQs, is up a little bit. And because of that, we're going to sell some of this premium. And this is the way that I would have approached my trade. Like I said, I probably would have had an out, just a good till cancel order to sell at a double. And that probably would have triggered overnight. But if I didn't do that, this is the way that I would approach this trade. Okay. So once again, nothing's meant to be a recommendation. We're just trying to learn here. I just always got to throw that out there. Okay. So if I sell the 356 strike, that's $2. And that looks really enticing to me. So I'm going to go down one more because this is the one I want to sell, but I'm going to give up some premium and go a little bit further out of the money. So if I were to do this trade, I would look to sell the 355 with the 929. Yep, that's right. Good. I got the right expiration. September 29th. Yep. So this is the expiration that I want to sell, 7 days away. And I'm going to bring in $1.73, and I'm going to give myself a wide range that is a very wide put spread. If it gets down to 355, though, I'm either got to roll this position or I just got to close it out and say, okay, my game is done. It's below 355. I'm going to close the entire trade out, and I still should be profitable on that trade. I just don't want this option contract to get in the money. And we're in the QQQ. There's a chance for a gap down, but the gaps down and the gaps up in ETFs that track indexes are usually a lot smaller than an individual stock, than just one stock based off in the NASDAQ. Okay. So this would be the adjustment to our trade. We'd be selling one of the September 29th expiration 355 puts, rolling into a diagonal put spread in the QQQ to go along with our 368 long strike put that we did that goes all the way out till October 13th, out to this expiration that I'm pointing out right now. That simple, that straightforward. It's an advanced adjustment in my mind, so it's not for the faint of heart. But we did say that this is a possibility. That simple, that's straightforward. Okay. So let's stay bearish. And I've talked this entire month about the fact that it's really hard to pick long option contracts considering the seasonality of the marketplace and just, the Fed's still saying they want to raise interest rates. We don't even really know all the effects of the raised interest rates. We got a big strike going on with the auto workers, and there's just a lot of news and potential landmines that are out there in the marketplace. And so it always seems that in September and October, if it's bad news, it is usually taken much worse in these calendar months. I think that would be the best way to explain it, is that bad news seems to not be received as well in September and October. That's simple. Okay, so here we go. I'm going to go back to the and before I get into this trade, it looks like I got a little frog in my throat. But before I get into this trade, let me grab a drink of water. If you do have any chats or any questions that you would like, just put them in the chat box. You got to be on YouTube. Go on YouTube, put in that little chat in that chat box, and I'll be happy to try to address any questions during the show or at the very end of the show. One more time. All right, I think I'm back. Let's do the paper trade for this week then. So we're going to go in, and as I've mentioned this before, one of my favorite adjustments, or my there isn't a golden book of answers as to how you adjust everything and how the adjustment's always going to work. But one of the first episodes of Options Guide TV, the marketplace was looking pretty rosy, and we just wanted to get long the indexes. So we did some long call spreads. And the adjustment on the long call spread is if the market goes against you, we're going to roll it into a butterfly spread. So now what we're going to look at, we're going to be bearish, and I'm going to do the opposite. I am going to put on a long put butterfly below the market and look for the downturn in the marketplace. And then I'm going to adjust it by rolling that into a short put spread, which would be a bullish trade if the marketplace takes off and starts going on up. And you do need to have some capital to do this trade, because when you roll into the short put spread, there's going to be a fairly hefty margin requirement. And we're only going to do it on a 1-by-1 basis, like usual. To start with, we'll have a one put butterfly, which is a 1-by-2-by-1 ratio that we're looking to do. But let's just set up that trade and see how the week plays out and see if there's a time where we may adjust that trade. All right. So normally I'd go down about 1%. So 1% with the market where it's at right now is about 43 points. I'm going to go below that, though, because like I said, I'm worried about this news event, and I want to target a range that if we get more than a 1% move, this could potentially work for us. So I'm looking at the 305 strike with the market at 350. We're going to do, we got to do a different expiration. Glad I caught that. We're going to go to October. I'm not 100% sure where I want to go just yet. October 2nd is a Monday. October 6th is the Friday. Don't know if I want to go all the way out to the 6th. So let's go to October. Do we got a 4th? Let's go right in the middle of the week. Okay, so that's the new budget is supposed to start on October 1st. October 2nd is the Monday after that happens. I'd either do the 3rd or the 4th. Guess we'll do the 3rd. We'll give that a little bit of time. So we're going to do October 3rd, and we're going to go down to about the 305 strike. We're going to be buying. We're not about. We're going to do the 4305 strike. We're going to buy that one. We're going to go down 20 points from there. And so that would be 85. And we're going to sell this one. And inside the TradeHawk software, it's kind of nice. All I got to do is click on it twice, and it actually puts 2 in because it's a 1 by 2 by 1. And then we're going to go down another 20 points, and we're going to buy the 42.65. All right. So in this instance, because we're so far out in time, we're actually going to be able to get this done for a net debit of $1 to put this trade on. It's going to give us a 40-point range. Now, here's the downside is that if the marketplace comes down right away and you have this trade on, you're not going to get paid right away. There's a ton of juice in these option contracts. Once again, the VIX is at 1621 right now. And because of that juice, in order to be profitable on this trade, we need this center strike. We need these option contracts because that's where we want the market to go. We need this $18 option contract to wither away. And that's not going to happen overnight, right? Because we're going all the way out till October 3rd. That expiration is 11 days away. So be realistic that if the market comes down to this range in the short term, that's a good thing. But if you double on your trade because it happened tomorrow, which would be a 2% over it, be about a 2% move to the downside, you're probably only going to make a buck on the trade. And that's fine. You risk a buck, you can make a buck. That's 100% gain. So just keep that in mind. That if it happens right away. Now, if the market goes against you, well, guess what? You lose a buck. If the market keeps going on up, well, and all the talk in Congress and there's no gridlock and everything looks good and the market starts going up, well, we can roll into a short put spread, or we could just let this trade go away and we lose our dollar and we move on. It's that simple. That's the way that we're going to approach the trade. So let me throw this in the what if calculator. And this will kind of highlight, if you look at this trade, and you'd see that when we put on the trade, the underlying market is right here. And as the market goes down, we have a huge profit potential at expiration. But right in this range, we're only going to about double on our position. So if we go from here, you see the green line is highlighting what happens if it happens prior to that expiration date, and it happens right away. But as time decays and those middle strike options start going away, we're going to slowly morph into the expiration graph. And that's where we're going to end up at. So this is going to be our paper trade for this Friday. I might have waited and put it on Monday, but the market's a little shaky right now. Mondays have a tendency in September and October to be fairly volatile days. So if I want to participate, if we do get a down day on Monday, I kind of want to be in this trade prior to that. So normally in my SPX trades, I will do them on a Monday and they'll expire on a Friday. And you got a 1 week period that you don't have any weekends to deal with. Special occasion. We went a little bit further out of the money. We're targeting a news event that could be happening. And because of that, we're doing a little bit longer term option contracts. And with that said, we do got a question. Good thing I checked before we headed out here. I'm going to add the question right now to the site. Not sure if this is the right venue for this question. All right. But can you show how to use the strategies tab in TradeHawk? I've looked around, but not found a reasonable tutorial. Yes, but you're right. It's not the right venue. But what I will do, Charles, is if you want, go ahead, and I'm trying to figure out how I could get your information, because I do know of a video that will work. And if I can get that information to you, there is a video that is available that is done by Lex, and Lex is the TradeHawk person, right? He's the founder, the brains that's behind the software. And I would try to get that information out to you. I'm trying to figure out how I can get that information to you. All right, I'll come up with that answer. Actually, if I'm assuming you are obviously a client of Tradier, I'd reach out to the trade desk. send that question to the customer service desk. And it's not that, if you look for Lex, there are a couple of videos that will highlight that strategy tab. But I thank you for your question. I just don't have that answer, and a little bit beyond the scope in this one video. But I do appreciate it. All right. Any other questions that we have that's in particular to the strategy? Can do that. No problem. Yeah. Sorry, Charlton, I didn't have a better answer, but Lex is the person that you want, and Lex has done a couple of videos that I've watched that deal with the strategy tab. All right, everyone. Well, great show with Russell. I really enjoyed our show on Wednesday. Please go back and check it out. This is going to be an interesting week. Been talking about this week in the markets on Options Guy TV now for some time, and the risks are real. So this is the trade that we came up with to try to play it. I actually wouldn't mind, maybe next week we'll probably stay in the indexes, and we'll maybe go to the SPY and look at actually just doing a good old-fashioned long put spread. But that's it for this week for Options Guy TV. Please click subscribe, ring the bell, and give us a thumbs up. That helps us out a lot here. And we'll see you this coming up Monday at 11 a.m. for the next edition of Options Guy TV. Thanks for coming, everyone.